Hey friends, I'm excited to cover two stocks in the video today. I own both of them. They both pay dividends, and they're both ancillary positions in the portfolio. I've been receiving questions from all of you at home about these companies, and so I want to cover them in the video today. I'm going to cover Viatris. I'm also going to cover Utz Brands Inc., which makes these pretzels. We still have a bunch of them here from the Halloween festivities. I want to cover both of those stocks in the video today because there's a lot of news on both of them. And I'm going to take a deep dive into the financials because it uncovers quite a few insights about dividend stock investing. On the one hand, with Viatris, we have a company that is growing very slowly, if not in decline over time, but it has a PE ratio of 3 and a high starting dividend yield. So that's one end of the spectrum of dividend stock investing. All the way on the other side of the spectrum, we have Utz Brands Inc., which is growing phenomenally quickly, but those results aren't all dropping to the bottom line just yet because they're still in that business mode right now where they're scaling revenue and they're growing quickly, but the investor could see long-term yield on cost if the plans come to fruition. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to give a quick snapshot on the financial metrics before I get into the deep dive. Check it out on the screen right now in front of you. There they are side by side. I have Viatris and Utz Brands Inc. The first thing I want to mention is these are smaller positions in my portfolio, which is very heavily weighted towards core stocks. Viatris comprises 0.4% of my portfolio, whereas Utz Brands Inc. comprises 0.5% of my portfolio. So if you add them up, they're still under 1% of the portfolio. This, quite frankly, is why I don't cover them quite as much, because I am all about core stocks and I have a core heavy portfolio. That said, the ancillary positions are fun and they all play a role. With Viatris right now, it's down 29% from its 52-week high. That off the bat catches my attention because I like looking at my stocks when they're trending down. Based on the forward earnings estimates, it is trading at a PE of 3 and change, but please keep in mind that you can see right here the earnings are going down over time. I almost look at Viatris like an annuity. It is a company, quite frankly, that is making progress in picking up new sources of revenue. I will go over that in the slides today. That being said, at a high level, selling generic prescriptions, prescription medications, this is a company overall that is in decline over long periods of time. Hence, it has a lower PE ratio. Based on the current dividend, the starting yield is 4.33%, but I think they have room to increase the dividend because the payout ratio is 14%, and they're repaying a lot of their debt, which I will show in a minute. So they're going to have increasingly more room to increase the dividend, and the last increase was 9.1%. This is a $13 billion company, so a good-sized company. As you can see on the right-hand side of the screen, I have Utz Brands Inc. This is a completely different type of company. This is a salty snack foods company, and it's only down 12% from its 52-week high, but it took quite a beating over the past few years. When it first went public via SPAC, it was a bit overvalued, I guess, as the market is finally now realizing its true value in the $17 range. I was one of those buyers when it first SPAC'd. I was buying at the higher levels, and unfortunately, it's come down from then, but I'm reinvesting dividends at these nice levels, and I have a lot of faith in this business over the long term. But I'm going to go through the pros and cons today because there's pros and cons with both of them. Based on the earnings estimates for Utz, the PE ratio is at a 34 this year, 31 next year, quite a bit different than the 3 PE ratio over at Viatris. But this side-by-side comparison just goes to show how much the stock market values growth and how little it values a company that's actually shrinking earnings over time. Now, the dividend yield on Utz at a starting dividend yield is only 1.23%, but its payout ratio is less than 50%, and its last increase was 8%. Market cap is only $1.42 billion. Long story short, this is a company that's growing quickly, that is investing in growth right now. And so, of course, the dividend yield in the short run is going to be low. And quite frankly, the earnings are a little bit lower in the short run than in the long run because they are in growth mode. And it's a really small company. But what I want to share with all of you as well is when I expect these companies to increase their dividends. Because even though they're on different sides of the spectrum, we're talking about a steady Eddie, if not declining business, and we're talking about a high growth business on the other side, both of them are actually in a good position to increase the dividend, especially on Viatris because the payout ratio is so low, and on Utz because the company is growing so quickly. And so they're kind of growing dividends, I guess, for different reasons and because they have different business models. But nonetheless, as you can see on the screen right now, the first thing I want to show you is going to be Viatris. And so what you see on this screen is a screenshot from the NASDAQ website, and it shows the dividend history of Viatris. It's only been public now for a few years, and so quite frankly, with these two stocks, they're both newer to the public markets, and people ask me, Ian, they're down. You're down on your investment. Are you going to sell? Of course not. The track record is just so short, and I have so much confidence in these businesses for my own personal situation. I, of course, will not abandon ship. In fact, when I look at the financials that I'm sharing today, I feel really good about these investments. But of course, I think it will take at least 10 years of time to really see how they are doing in the public markets as they scale. But with Viatris, you can see back on January 4th of 2022, they declared the higher dividend of 12 cents. The prior dividend was 11 cents. And so for folks who are investing in Viatris like myself, I think we will all want to look come January of 2023, around January 4th, we're going to want to look for the dividend declaration. And hopefully they're going to declare another increase. So that's when we can expect it. And as you can see on the screen right now in front of you, I'm going to share the same for Utz Brands Inc. You can see their last increase was declared on December 9th of 21. And so that's just around the corner for us here. I think sometime in early or mid-December, we could possibly look forward to another declaration of an increased dividend. And so I can't wait to see those for both Utz and Viatris. You never know. They may or may not happen, but certainly I will be watching the press releases around those dates to see if they declare higher dividends, dividend increases, true passive income, increases of income in my wallet that I can use to pay bills, although I'm not using the dividends from these two right now. I'm reinvesting them because I believe in these ancillary positions. Now, I want to keep going. By the way, if you enjoyed the video so far, please go ahead and click that like button. It really helps me out. And what I'm going to do for the remainder of the video here is I want to go into a deep dive in Viatris, then a deep dive into Utz. And so as you can see on the screen in front of you right now, let's talk about Viatris. They recently, on November 7th, reported strong third quarter results for third quarter of 2022. And you can just see on the screen here some of the things they're prioritizing. I love that last bullet point that they're prioritizing the dividend, and hopefully they'll increase that dividend in January. I also like the second to last point where they're prioritizing the repayment of debt. They paid down $2.1 billion of debt year to date, 1 quarter ahead of schedule, and they are having strong cash flow. year to date, approximately 2.56 billion in free cash flow year to date. And so one thing though worth mentioning with Viatris that I saw throughout the earnings release is they are facing some headwinds on them when they are converting sales that were made outside of the US back into the US dollar, because the US dollar has been strong. And so the conversion rate is hurting them on their international sales when they convert it back here into dollars. And I don't really look at that necessarily as a bad thing as an investor, because currency conversions change and fluctuate all the time. Dollar is strong now, but it may not always be as strong as it is right now. And so I don't really factor that into my analysis, at least in a negative way, when I'm analyzing companies like Viatris. I want to keep going. Check it out on the screen in front of you right now. The next bullet point that I want to share is a summary, a income statement, if you will, from the 9 months. I actually didn't take the 3 months because I think with the 3 months, it was a little misleading. Free cash flow was a little light, whereas in the 9 months, it was stronger. The reason I'm looking at the 9 months is CapEx, capital expenditures, which affect free cash flow. They can kind of be higher in one quarter versus another. And so I don't really worry about that too much. Capital expenditures are investments in the business itself. And so quite frankly, I just wanted to look more at a 9-month period. I felt that was a better prognosis of how this company is performing. And you can see at a top line with net sales, it's shrinking, both on a GAAP reported change, but also on an operational change. The operational change is actually taking a constant currency and taking out the impact of currency conversion. So you can see overall, this is a company in decline. The sales are declining. And I think that's something important. Why does it have a PE of 3? The reason it has a PE of 3 is for the foreseeable future, this is a company probably that's going to have sales and earnings in decline. And so it's being priced more like an annuity. And I keep saying this word annuity. For those that don't know, what is an annuity? An annuity is a financial product that is typically offered by a life insurance company. And what you can do with an annuity typically is you can put money into it, you can invest in it. Sometimes an annuity will offer mutual funds that an investor can select from. And then when the investor retires, the investor has the opportunity to annuitize it. And basically when it's annuitized, that investor receives monthly cash flow for the rest of their life until they pass. And sometimes for certain annuities, it also waits till the second person passes, if you're married, for the annuity to stop. Obviously, this is a life insurance product because there's a risk assessment around actuarial assessment around how long the investor will live. And on those monthly payouts, what's happening with the annuity is it's returning capital, but also it's paying kind of an interest rate on the capital that has accumulated as well. Now, fun fact, if an investor owns an annuity, the investor does not necessarily have to annuitize it. It's also possible, to my understanding, just to take distributions out of the annuity without annuitizing, or just leaving it as is and passing it on in one's estate, if you will, to future generations. But again, why I say Viatris is like an annuity, it's like an annuity that gets annuitized in some ways. It's a financial asset with great value, but the value of that is diminishing over time, like an annuity that pays out every month that has been annuitized. And at a certain point, it will have some kind of terminal value, if you will, just like a annuity when the first or second person on the contract passes. And so that's something to keep in mind, and why the PE ratio is so low. But let's keep going. As you can see on the screen in front of you right now, what I want to share as well on this particular income statement is we look at stuff like adjusted gross profit. Let's just look at that line. It's down 8% year over year. Let's keep dropping down. Adjusted net earnings down 7% year over year. Adjusted EBITDA down 9% year over year, and it's even down 4% year over year on an operational constant currency basis. I think I've made my point here. Annuity, business in decline, but it still has some value, and I think it's being probably traded lower than it should be when it's at a PE of 3. Let's keep going. As you can see on the screen now, I want to give some more updates on Viatris. It's been a while since I've talked about this. Let's look at this. Third quarter highlights. I wanted just to share one thing here on on this particular screen, there is a paragraph, the third from the bottom, or the 1, 2, 3, 4, fifth from the top. The company generated approximately $144 million in new product revenues, as defined in certain key terms below in the third quarter. $350 million on the year, driven by blah, 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 a bunch of stuff. So long story short, I liked seeing that because what it's showing is that Viatris is innovating and investing in new products, new revenue growth, new earnings growth. Because as I said, it's an annuity. The only way this thing is ever going to go from a PE of say 3, 4, or 5 up to maybe a PE of 8, 9, or 10 even is going to be if they get on a growth trajectory, because the market values growth. We're going to see that with Utz. It's trading at a PE over 30 because it is growing fast. We know that the market is forward looking, it values growth. If Viatris wants to be valued higher, they need to show growth, and they're only going to do it through these strategic imperatives, and it's nice to see that they're generating a good amount of revenue from them so far. So I like that slide, but I think we're going to need a good 5 or 10 years to really see what they can do here to stop the company from shrinking. Let's keep going. As you can see on the screen in front of you right now, the next thing I want to share is the balance sheet. I just want to highlight one item there. Long-term debt, it's down year over year, but it's still big, $18 billion. That's another reason this PE is 3. We're in a crazy interest rate environment now where I can earn over 4% on a short or long-term treasury note or bond, and I own them, by the way. Yields or interest payments for companies like Viatris that need to refinance debt, it's going to be high. And when you have this much debt, yeah, it's down year over year, but it's still high. And so I think until Viatris really gets the debt down more than it has, it's going to trade at these bargain levels, if you will, or these low levels, if you will. I still think they're bargain, but I think also there is a reason it's at a PE of 3. Let's keep going. As you can see on the screen in front of you right now, next slide I want to share is key product sales. Basically, you go through their key products, they're all shrinking, more or less. I think there's 1 or 2 on this entire screen that is not shrinking. And so I just wanted to use this to hammer home the point. The stock is trading at a PE of 3 for a reason. I think it's probably undervalued and trading too low, but there are issues. The biggest issues it faces are the debt load and the shrinking business. The good things about this company is it sells generic prescription drugs which people need for their health. It has a great dividend, low payout ratio, conservative payout ratio, room to increase the dividend, room to continue to pay down debt, and I think long-term, they're going to do just fine. And so I look at it as a value stock that just the market hates. I continue to hold it. I'm reinvesting dividends. I'm not selling it. I'm not really adding to it though right now because I'm only adding to basically my top 10 core stocks. From here on out, that's just a decision I made for myself that I've already discussed in some other videos. If you're enjoying the videos so far, by the way, please don't forget to subscribe. I have new videos on the way all the time. It's really late here. I'm up late at night and I'm just going to stay up late at night to finish this video because if I don't, literally my days are so busy the next few days that I won't get the video done. And so if you appreciate me staying up late at night to talk about Viatris and Utz, please subscribe. It means the world to me. All right, I want to talk about Utz Brands Inc. Check it out on the screen right now. Utz Brands Inc. reported their third quarter. They increased their full year 2022 outlook. So this is a classical example of the stock is down, but that doesn't mean the company is doing bad. Company is doing just fine. It just means it was overvalued. When it SPAC'd, a lot of investors, myself included, had trouble valuing the stock. And I thought at higher levels of the stock price, there was more value there than it turned out there was. And it's hard to analyze a net new publicly traded company. It's so much easier to analyze a core dividend stock that's been on the public markets forever. But long story short, stock's down, but the company's doing fine, just fine. And so net sales increased 16% year over year. Organic net sales, 12.6%. Organic basically takes out the acquisitions they've made. And so that's just existing brands they already have are growing year over year. Their adjusted EBITDA is growing 6.5% year over year. I'm not going to go into everything on this slide, but I'm going to tell you the story at Utz and why Utz is probably trading a little lower than maybe It could be. Sales growth is great, but I'm going to tell you a story in the video today, and the story is that it's not dropping to the bottom line. And I think that's intentional. I think the company is in growth mode, so they're not quite as focused on their bottom line. But eventually, for this stock to increase in price and value, they're just going to have to grow that bottom line. They're going to have to bring the PE ratio down, and they're going to do that by growing the bottom line. The top line has to drop to the bottom line, and it's not just doing that just yet. But I also give them a pass here because, quite frankly, they need time to just grow the company, and they're growing after a land grab right now just to grow this company as quickly as they can. Let me continue. Check it out on the screen in front of you right now. The next thing I want to look at with Utz Brands Inc. is, again, just a summary here of their numbers. I love the net sales growth at 16%, but if we drop all the way to the net income, this is what I'm trying to tell you, they're earning nothing. Literally, it's kind of a nominal amount. What is that? $1.5 million here. And so it's nominal. They're not earning a net income. Until they do, it's going to be difficult for this company to receive a higher valuation than it has. That being said, I'm investing it for growth. This is a company with a market capitalization less than $2 billion. This is a fun stock for me. This is a growth story. I'm not really investing in this thing for wild earnings right now. I'm investing in this thing for long-term dividend growth, yield on cost, looking 10 or 20 years out. Let's keep going. As you can see on the screen now, I want to share another screenshot, and this one is the balance sheet. What I did want to point out here is I like their balance sheet. It's really sweet. Overall, I'm just going to compare assets to liabilities, and you're going to see here they have total assets of about $2.8 billion, total liabilities of about $1.3 billion. Overall, just when I scan this balance sheet, I like the fact that the debt does not seem to be overwhelming. The way it does seem to be with Viatris, hence the premium valuation for this particular company versus Viatris. Now, I want to go on. I have another screenshot. Check it out in front of you right now. The last one I want to share today is cash flows. This is important. Why is Utz Brands Inc. trading down at $17 when a lot of us were probably hoping for it to be higher, up in the mid-20s or even 30? I'll tell you why. This company, net cash provided by operating activities, here we go, is about $8 million. But let's see, they have net cash used in investing activities. And basically, the net cash used in investing activities, especially the purchases of property and equipment, which is capital expenditures, basically cancels out the net cash provided by operating activities. So if I have net cash provided by operating activities, I take out the money they lost by basically capital expenditures because they are in growth mode. They have a negative free cash flow. So this company is not earning basically enough money to really, quote unquote, pay the dividend. But if you drop on this cash flow statement a little lower, you can see net cash provided by financing activities, and they're doing some stuff on the financing side to kind of balance out the scale. And you can even see there under the financing activities, it shows the dividends. They're taking out about $12 million a year there on the dividends. And so anyways, you can see, quite frankly, why it's trading at a $17 per share and a PE of 30 at that lowly share price is because, quite frankly, earnings are strained. The company is growing. I see a lot of promise there. It's a growth story. I don't really fault them for this, but over the long period, I sure would like to see a positive free cash flow and a positive free cash flow even after we take out dividends and financing. So I guess that would be a positive levered free cash flow, if you will. And so you can see all the way at the bottom, the cash and cash equivalents at the end of the period is kind of growing, but it seems like a lot of that is done through the financing side of things and the debt side of things. And so that's the story with Utz and why it's trading where it's at. And so we see two stocks, they're ancillary positions. I believe in both of them. but they both have their goodness, they both have their faults, and that's why they're trading where they are, in my humble opinion. If you're seeing something different than I'm seeing, or if you just want to comment, show some support for me staying up really late tonight, I would love to see you in the comments below. I always read all the comments. I try to respond to most of them. They mean the world to me. I really appreciate it, everyone. If you like this content and you want to see more of me, I share so much valuable content over on Patreon. I will link to that in the pinned comment. I share my complete stock portfolio, percentage allocation to each position over on Corner Patreon, which is the higher tier. Check it out. And if you don't mind, I would totally appreciate it if you dropped a like. If you click the like button, it means the world to me. Before I go today, in terms of a full disclosure, I do own the stocks mentioned today. I'm on Pfizer, ticker PFE, Viatris, VTRS, and Utz Brands Inc, ticker UTZ. I own those 3 stocks in my personal Dividend stock portfolio. I'm also long Treasury bonds as well. Before I go, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here for fun and entertainment. It's possible to lose money in the stock market. And before we go today, please put in the comments below, do you like to invest in ancillary positions, smaller positions like I do just for fun? Or do you only focus on the core? I wanted to kind of mix things up today and share 2 stocks that I love, but they're just smaller in my portfolio, and that's where they're going to stay probably, but I still like them, and I'm still happy they're on my team. I love you all. I'll see you in the next dividend investing video.